Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed right here on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. And joining me today, we have Shawn Cruz, Manager of Trader Services at TD Ameritrade. And Shawn, the Nasdaq-100, believe it or not, is back to even. So we want to discuss what's driving the relative outperformance. Before we even get into that, give us your view on what you're seeing in the markets today and what's going on our first slide, where we're seeing the outperformance in the overall Nasdaq composite.
Yeah, right now, it's not just that the move higher today is certainly something that's strong, and you've got the S&P up a little over 2.5%, but you got the Nasdaq up, we'll call it 4%, and you can see the breadth just by looking at the screen. You've got about 1,700 advancing issues, only 763 declining, and the areas where we are seeing weaknesses in financials, which if you look at what we heard from some of the big banks today, J.P. Morgan and Wells Fargo, really sort of showing a lot of concern around their loan book, having to increase their loan loss provisions. I think there's a sense that they can maybe handle a shock like that, but some of the smaller regional banks may not be as well prepared or insulated from that. So you're seeing a lot of the smaller regional banks take a hit, but other than that, pretty solid strength across the board out of the Nasdaq today.
All right, and take a look at our second slide here. Volatility is also continuing to fall as skew begins to flatten out. Tell us what you mean by that.
So when you look at this, and what this is showing is, everyone I think is familiar with the VIX, or the spot VIX as we call it, which today is at the 38 level. So it's down today almost 8%. So it continues to fall, which is a good sign that some of that fear is leaving the market. But you typically expect to see actually the near term, these contracts here on the far left for the VIX, the futures on that for April, trade at lower values to anything that's going to be further out, or what we call a contango market. So I would expect the March contract, the April contract to be lower than the May, and then the June contract to be higher than the one in May, so on and so forth. When you get markets that are hyper focused on short-term moves and short-term swings back and forth, that's what drives that nearer-term contract higher. And so if you look what we have here, I just pulled up where this curve was sitting on March 30th, and you can see how much higher that April contract was compared to the following months. It's a very steep curve showing there was a lot of uncertainty packed in that very short period. If you look at that now, you actually see that the May contract, going all the way out to November, there's really only about 4 points of difference there. So you went from being up near 50, and then the contracts out this fall being there, the 28, 29 level, to now the near-term contract settling down to about 32. So it shows that markets are starting to feel a little bit better about the glide path of things moving forward. And this can actually be something that can help investors feel a little bit more confident about coming back in and buying this market. And I think that's why you're seeing these broad rallies, and that is just money generally getting put back to work in the market overall.
All right, and if we go back to our third slide here, back to the Nasdaq-100, showing that outperformance, and you had mentioned before it doesn't have that exposure to energy or the financials, but it seems as if what led the way in 2019, and especially January and February, with those core large cap tech names, is really what's starting to lead the way again here.
Yeah, and I think it's interesting just to point out and think about what constitutes the Nasdaq-100 versus some of the other indices. And it's going to be a lot of these tech companies that, one, are seen as disruptive to various parts of the economy, but they benefit in that they can, one, not be somewhat asset light, but drive a lot of revenue. They scale really well. They usually have very good profit margins, very good growth as well. And if you think about what does well when the economy is chugging along, businesses are investing, they're making investments into technology infrastructure, that benefits a lot of these companies in the tech and communication sectors. And then in this pullback, we've actually seen that these are the companies that are still relied upon by households for a lot of different things. And I think that is reflected in some of these names that have really been leading us higher here. And you can look at Microsoft, you can look at Apple. Netflix has been incredible, up over 25% on the year. You also have Google, and Amazon are other names that are in there. And these are the companies that have held up relatively well versus some of the companies in other sectors out there. And the Nasdaq having a pretty heavy weighting towards these is driven that outperformance. So if you're holding Nasdaq 100, and that's sort of what you've been investing in, you're down only 2% on the year, which you think about all the vol we've seen, you feel like there really shouldn't be any index out there that should be up or down less than a couple double digits. But S&P, Dow both down over 12 and 17% respectively. But the Nasdaq still holding in there, and you could, relatively speaking of what we see from the SPX and the Dow Jones, the Nasdaq being down only 2%, I think you could almost call that being flat on the year.
Yeah, well, certainly with today's market action, we definitely are. And if we take a look at our next chart here, switching over to energy, it's crude oil, what's it down almost another 1.5%, 2% for today, and that's just going to continue to impact the energy sector.
It has, and that's been something that has been extremely volatile. We've seen a lot of volatility focused in on the energy sector and to some extent the utility sector. And there was a little bit of a tie-in between energy and utilities. But right now, energy just really can't catch a break. And what we've heard from a lot of CEOs of these energy companies is that crude oil trading below $30 a barrel is very problematic for the industry from just a revenue and a cash flow basis. And there could be some more trouble on the horizon for the energy sector if crude oil remains this low. So I think everyone wanted to see, one, what OPEC would do and what the market response would be to that. By marketing the crude oil market, OPEC came out and they actually got the cuts a lot of people wanted, and you saw crude oil fall, regardless of that. So I think what that shows is that you need to see, one, further or more extreme supply cuts, and I think that's going to be a little bit more difficult to achieve here moving forward, or you need to see some sort of a return to actual physical demand. So equity markets are showing you that the real panic and concern that things are going to completely fall apart is coming out of that. But if you look at crude oil, it's still showing that there's a little bit of uncertainty just in terms of demand for crude moving forward. And that's going to be something that's going to need to correct itself if you want to see energy, get a little bit more of I'd say a positive outlook. But right now, crude oil at 20 is definitely going to be something that's going to hang over the energy sector moving forward and continue to drive more volatility.
All right, and wrapping up with our last chart here, as we look at Nasdaq-100 earnings that are on the horizon, Intuitive Surgical is up on deck.
Yeah, Intuitive Surgical, that's a company that I think it's going to be pretty interesting to see exactly how COVID-19's impact on healthcare businesses across the country has actually impacted demand for their products. And I think what really drives a lot of the value for the company, what investors focus in on, are the Da Vinci surgical system. So we're going to wait and see if they've seen a lot of cancellations in orders versus maybe a delay. I think markets will be much more forgiving of a delay for some of these orders than outright cancellations, as you start to see a lot of these elective and other surgical procedures get postponed while we deal with the coronavirus outbreak. But just looking at markets right now, markets are pricing in about a $20 to $21 move in either direction post earnings. But if I'm looking at the chart, I like to look for these high volume levels or areas where you see a significant pickup in volume. And you notice we're sort of peaking out right here around the $500 level. There's a significant amount of volume traded here. So I think it's going to be interesting to see if that 500 level can hold, because otherwise you start to sell off and through that 500 level, and it'll be interesting to see if we do get some sort of a bid returning. And then on the upside, you actually see volume taper off when we get $20 higher. So I think that actually can also sort of serve as a ceiling on the upside here. So definitely will be interested to see what happens when Intuitive reports earnings here in the next couple of days.
All right, Shawn, as always, thanks so much for the insight.
Thanks.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.